All right, welcome back. Thanks for joining us. It's record high after record high, isn't it? It's hard to get in front of it. And in the markets, record highs usually give us more record highs. U.S. stocks edged higher yesterday, and some are trading a little higher today as Wall Street has kept up its record-setting streak of the back-to-back highs with big tech mega caps. NVIDIA, well, that stock surged to close at a record high yesterday as the company announced it would invest up to $100 billion in OpenAI. That's a big one. Tesla was also rallied near its 2025 high as investors looked ahead to the company's self-driving future and new products. New products, well, you should read robots there. My next guest is a good market prognosticator. So please welcome to the show, Mr. Eddie Ghabour. Eddie, thanks for being on. You've been doing well. You've nailed it on this show, that's for sure.
Thank you.
So what does the ride look like from here on out?
So I think short term here, it's going to get a little bit tougher. We've had a really nice run up, but I want investors to kind of take a step back and think about where we're going to be 6 months from now versus 6 weeks from now. The main thing that we're taking away from this market is this is probably the most hated bull market I've seen in my 27 years in doing this. And the amount of pessimism and short interest that continues to increase on this market as we hit new highs, to me, is unprecedented. And so I think the setup is for us to have a much higher to go from a market perspective due to positioning, due to Fed policy, due to where we think the economy is going to go over the next 6 months. So any chop that we get here to the downside over the next few weeks, we would look at that as another buying opportunity. And I think these dips are going to be shallow because so many people are on the wrong side. They're forced to buy. And as we get closer to year end, those buys are going to be even faster and more aggressive. So I think it looks really good.
Yeah, those unfortunately that voted with their politics in April, thinking that Donald Trump was going to kill the market in the world. A lot of that money hasn't come back in, and there's reports that it's up to $7 trillion. I don't think we're going to see $7 trillion hit the market, but isn't there a time frame where slowly but surely that's going to have to come back in so those money managers don't have to do too much of explaining to their customer base why they missed the rally?
It's exactly right. So you're going to have two things happen. You're going to have performance chasing happening here in as we go into the fourth quarter. To your point, they're going to try to keep their job. But the other thing is we know that ultimately investors always capitulate at some point in time. And that capitulation is usually happening in the last leg of a bull run, and that's when you can make the most money. So I continue to hear people saying, well, the market's overvalued, it's overvalued. You may have a valid argument, but valuations don't matter right now. I would follow technicals and the trends because things can get much more overextended than where we are now. Just look back to the tech bubble that we had in the 90s. Valuations were much higher than where we are today. So, and we actually have companies making real money in this cycle. So,
right, I was going to say.
This is as bullish of a setup as you can get as a bull. And I just hope people don't miss out on this generational opportunity.
All right, so then let's flip that coin over and then talk about what worries you. What do you see on the horizon that you still need some more clarity on?
So the most challenging part in the area that could derail our entire bullish thesis is if the 10-year bond gets back to spiking up due to inflation accelerating. The Fed's going to have a really tough job. And right now, I think the market's a little too optimistic on how many rate cuts we're going to get, because we see the economy accelerating growth-wise, which means we also see inflation accelerating in the coming months. And if the labor market starts to strengthen instead of getting weaker, the Fed is going to have zero reason to cut rates, and that's when you'll get that repricing in the bond market. So the bond market, the dollar, and the VIX are the three things that we watch extremely closely. And when one of those things start to break, that's going to be when this party ends either short term or turns into a bearish trend. So those are the three main things that we are watching.
The Fed, they've waited so long, almost in the hopes of inflation, because they wanted to be proven right, I think. That really didn't show up yet. I mean, there is some inflation, and I don't think tariffs are really going to be the big one. I said this in the last segment. I'll say it again tomorrow. Money supply is higher than it was when we had a 9.1% CPI. So that's going to be something that's got to worry the Fed. They see what we see, right? So that is going to be the inflation driver, I think, when and if we have one. But you're right, that 10-year yield's going up 412, 413, 414. When we were down below, we did poke our head below 4% before the rate was cut at the Fed funds rate level. So that is going to be a dance that they're going to have to do for the next, again, 6, maybe 9 months, because he's also got the risk of a weakening labor market and all these inflation indicators coming in hotter than expected, because they have been coming in slightly hotter than expected for the last 4 months, right?
That's exactly right. And that's why our thesis is, even though these are risks that we're looking at, we think the Fed is going to turn a blind eye to inflation. And because they're so late to the game, once again, they're going to be forced to cut rates, regardless of the scenario, over the next 6 months. That's going to be the trend. And when you cut rates in a non-recessionary environment, with the stock market at all-time highs, that's like putting fuel on a fire. And this is why we think this market is going to go up much higher than even the most bullish people like myself on the street think, because we've never really seen an environment like this where you have global liquidity increasing at a fast pace while the market's at an all-time high. So this is a really, really interesting market.
Yeah, I mean, that's the one thing, that's a big problem. I think the rest of the market's looking at, the rest of the world's looking at. A lot of folks are following us, but, he when he said that he's not quite sure that he knows what the jobs numbers are going to be next month, but he definitely feels like we're going to have inflation at 2% by 2028. I had to turn off the volume because that's ridiculous on its face, right? And that, I think that's an issue that we don't have the same confidence that we had in him. He's going to be gone in May. We need some leadership there. So this thing is really going to be an interesting soap opera. Again, they've waited long enough for, I would say in the hopes, that's being negative, in the hopes of some inflation. It hasn't really come through, but they waited so long they saw the job market start to erode on them, and all of a sudden now they got to start cutting rates when that really wasn't going to be one of their things that they wanted to do. 10 seconds, too, before we go.
Yeah, unfortunately, they're late to the party again. This is why they're going to have to be more aggressive on their cuts, even though the economic cycle may not necessarily be warranted. And that's due to them being late to the game. And again, that's as bullish as it gets. Put fuel in the economy while the economy is accelerating, and asset prices will go much higher. That's our opinion.
All right. Well, run one more time before you go, though. How about this? How about them? Do they give up on the 2% inflation target and go to 3%? Because that would be a lot of. I think that'd be more fuel to the fire.
They absolutely, in our opinion, that's what they're going to do. They're going to have to. We're not going to see 2% inflation. We are structurally changed. When you look at the debt bubble we are in and you look at where we are not getting to 2% unless there's extreme damage done to the economy, and no one wants to see that on their watch.
I agree. When they change it to 3%, I think we fly again. So anyway, thank you very much for being on the show, Eddie. Great stuff, as usual. See you again next week.